YOLO. Today I wanted to go over how you actually make money in the stock market. The top 3 ways that there are. And before I get into that, this video is for financial education and entertainment purposes only. Now that that's out of the way, let's go ahead and get started. So, to understand how you make money in the stock market, you first have to understand what is a stock. And simply put, a stock is a small portion of a business. You become a business owner, if you will, when you buy stocks. And the money that you spend buying the stock is then taken and used to either pay the previous owner of the stock, another investor, or if it's the company's stock themselves that they sold to you, they then take that money and they can use it for anything such as upgrading infrastructure, expanding to new locations, covering one-time expenses like refinancing high-interest debt. That's what a stock is, and that's what the money is used for. Now that we understand that buying a stock makes you a part owner of a business, we can look at the first step on how to make money in the stock market. Alright, the first way you make money in the stock market, and this is personally my least favorite way to make money in the stock market, is by selling your stocks. If you bought a stock and then you decided to sell it later on for a higher amount than you bought it, you'll make money. Now, there's a couple problems with this. The first one is taxes. There are a lot of people who do day trading. Day trading pays one of the highest possible taxes in the stock market. The reason being, the stock market is designed to promote investing, not gambling. So, when you go and you buy a stock, if you hold that stock for less than 365 trading days, that excludes things like holidays and weekends, you will be taxed at the highest possible tax rate that they can get you, which is the ordinary income tax rate. But if you buy a stock and then hold it for 366 or more trading days, you'll be taxed at a much lower, more favorable capital gains tax rate. This is to help encourage people with a carrot and stick setup to not go around investing and hopping in and out of positions, but to focus on the more long-term gradual growth of a stock. The second main problem with making money like this in the stock market is you no longer own your asset. You've sold out of that position, so if it continues to go up, that's all money that you could have had. Now, vice versa, it could have gone down, and then you might have lost more money or not been able to lock in your gains. And there are ways to work around that later on number 3. But for right now, selling out of a position means you no longer control that position and you can't make any more money from it in the future unless you buy back in and start the process over again. The second way that you can make money in the stock market is my favorite way, which is by dividends. Now, not all companies pay dividends. You'll have to do your research on them. But dividends are the closest thing to truly passive income and free money that there is. Now, what a dividend is it's a cash payment from a company to their shareholders. Think something like McDonald's. They make their money from, well, they actually make their money from real estate, but that's a separate thing. So we're just going to focus on the sandwiches they make. They make a bunch of burgers, they sell a bunch of fries, they have money coming in. Now with that money, they paid all their bills, they have a surplus, an excess of money. Now, they only have so many locations that they can add new stores to, so some of the money goes there. Now, upgrading their systems and infrastructure, some of the money goes there. Now you get those self-checkout little things. And one of the other things they could do is pay down debt. They could stockpile cash, but as we all know, inflation makes money worth less over time, so it's not a very wise idea to just have huge stockpiles of cash for no reason. So what they could do is with the excess money, they go and they give some of it back to their shareholders. Not all companies pay dividends, and not all dividends are the same. However, they do follow a similar formula, and it goes like this. First, they're going to have a declaration date. On this date, they're going to announce how much they're going to pay in dividends per share. So if they said they were going to pay $1 per share and you owned 100 shares, you'd get $100 in dividends. The second date to look out for is the ex-dividend date. On this date, they're basically going to count up all the shares everyone has. Now, you have to have your shares and own your shares before the ex-dividend date to qualify for that pay period's dividend. If you buy on the ex-dividend date, you're not going to qualify for that current dividend for whatever it is, month, quarter, or year. And then the final date to look for is the payment date, the date they will actually give you the money that you owe. Now, in the olden days, they would send out a check mailed to you, and it would take weeks. But this is the future. We have the technology. You can just see it digitally, and it'll be there usually by the end of that day, trading day that is. The money will enter your account. Now, when you receive your dividend payments, there's 3 things you got to know. First thing, unless you're in a Roth IRA, you do owe taxes on this money no matter what you do with it. So maybe budget and plan accordingly. I did not know that when I first started investing, and I got a little bit of a sucker punch tax season when it rolled around. The next 2 things you need to know is if you're going to reinvest your dividends or take them as cash payments. If you take them as cash payments, they go into your brokerage account, and then you could do whatever you want with them. If you reinvest them, it's referred to as DRIP, the Dividend Reinvestment Program. And what that does is it takes your dividend and buys a little bit more of the stock. That way, the next time this happens, you get paid a slightly larger chunk. And then that slightly larger chunk buys more, and so on and so forth, until it snowballs into massive payments, which is what everyone calls the dividend snowball. How long this takes and how well it does depends entirely on how much you're putting in and which stocks you invest in. But this is my personal favorite way of making money in the stock market because it's the most hands-off way and the least stressful over time. And the final way of making money in the stock market that we're covering in today's video is call options. I've written call options myself with varying levels of success. It is definitely a bit of a learning curve, but once you're able to understand it, you can make some serious money doing it. However, it's very high risk, and I do not recommend it for anybody who is getting into investing early on. This is more of a later game skill set that you're going to want to acquire over time. Now, what a call option is it's a contract between 2 investors where you sell the opportunity, but not the requirement, for someone to buy 100 of your shares per contract at a certain price by a certain date. And in exchange, they give you a premium. They pay you to lock in the price. And then they can wait around and make a decision on if they want to buy your stocks at the agreed price or not. Say you agreed to sell 100 shares, each for $1, and they gave you a $10 premium. Then they waited, and they decided to watch the stock. It shot up to $30 a share now. That's a $29 increase. They pay you the agreed upon price. They then own your 100 shares, and they can go and sell it at the $30 price, which is the current market value, and they make a ton of money. Or the price could go down, and now the options are each stock is worth only say 30 cents. Well, it doesn't make sense for them to pay you the agreed upon price when it's now much lower. They'd be taking a massive loss. They let the contract expire. You get to keep all your stocks, and you get to keep the option premium. Now, when you sell a call option, there are 3 things that can happen. 1, you sell at the money. That means you sell it at the current market price. 2, you sell above the money. So you're selling it at a higher price. Say the price again in this scenario is $1. You're selling them the option to buy your stocks at $1.50. And then you have in the money, where you sell at a lower than current market price. So you sell them the chance to buy your stocks at 50 cents when they're currently $1. Now, when you sell in the money call options, you get a higher premium because there's a much higher chance that they're going to take the deal. When you sell out of the money options, there's a much lower premium because there's a much lower chance that you're going to have your options assigned. It's a risk versus reward kind of thing. Now, during the option contract, 3 things can happen. 1, the stock can stay the exact same price, which is very unlikely, but theoretically possible. 2, the stock could go down, or 3, it could go up. Alright, forgive me for the repetitive gameplay here, but I have a little bit more ground to cover. So, if you sell your call option, and you sell it at the money or in the money, and the stock goes down, the chances of it getting called are almost 0. You make money and you get to keep your stock. If you sell it in the money or at the money and it goes up, they're going to almost guaranteed call your option. You're going to be assigned. You're going to have to sell all your stock, but you get the money that you agreed upon. And if you sell above the money and it goes up, then there's a chance it'll actually be called up depending on how much it goes up. So it's a balancing act of where you think the stock is going to go and where it's currently at. Call options are a bit more on the gambling side because it's a higher risk and it's more of a prediction on where you think the price will be rather than a straight up value proposition on the actual business itself. Now, that being said, there are things called macro indicators, major events that you can watch out for to give you a big idea on how it's going to go out. For example, I was listening to President Trump in late 2024, early 2025 talk about tariffs, and I knew tariffs would cause a massive drop in the market and panic. So, a few days before he had signed all the tariffs into law, or not law, but before he made all the tariffs, I sold deep in the money call options on several different positions I owned. Now, what this did was it almost guaranteed that all of my call options would be assigned and I'd have to give up all my stocks if the money stayed the same or went up. However, the market crashed because of it and I made about $14,000 premium. So I'm going to have to pay some big taxes on that. But that would be an example of a macro indicator, a major event on the outside that had nothing to really do with the businesses themselves that you knew would change the course of the stock's price. Options are a great way to generate additional income on the stocks you already own. If you're able to do this without having your calls assigned, it's similar to a second time of receiving dividends from the stock. That's why I don't really care for selling my stocks that much, because I can't receive dividends if the stocks are sold, and I can't write call options on the stocks. It basically allows me to double and possibly triple dip, because if they ever do decide to sell the stock, I make money from selling the stock, plus I made all the money from dividends over the course of the time I owned the stock, and I make money from the call options of that stock itself. If you enjoyed the video and found it informative, go ahead and drop a like, and also let me know in the comments below which of these 3 is your favorite way to make money in the stock market, or do you do a combination of them like I do? Thanks for watching the video, and I'll catch you on the flip side.